Hello, and welcome to this edition of the ESOP University presented by PCE Investment Bankers. PCE is an investment bank providing M&A, corporate finance, and ESOP transaction services to middle market businesses. Today, we're talking about the ESOP side of our business, and specifically, tax incentives provided to business owners who choose to sell their stock to an employee stock ownership plan, or an ESOP as it's commonly known. My name is Will Stewart. I'm an investment banker and partner with PCE Investment Bankers, and I work in our Orlando area office. I'm pleased to be presenting to you on this topic today. ESOPs are an attractive option for business owners evaluating succession options. They provide meaningful benefits to all core constituencies: the selling shareholders, the company itself, and the employees. This edition of the ESOP University will focus specifically on the tax incentives available to the selling shareholder. Make sure you watch our other video where we discuss the tax incentives available to the company. ESOPs are a sale of all or a portion of the stock of the business, much like a sale to a third party. The majority of these sales are taxable events to the selling shareholders. Any business owner that sells their company for a gain will be subject to taxation on the proceeds from that sale. Structuring the deal as an asset sale or a stock sale will dictate how the seller is taxed. In an asset sale, which is an advantage to the buyer, the proceeds will often be taxed at a blend of capital gains and ordinary income tax rates. In the sale of stock, which is often an advantage to the seller will only pay capital gains taxes. A sale to an ESOP guarantees a stock sale, which is already an advantage to the seller. It also potentially allows the seller to defer or avoid all capital gains taxes on the sale of their business. This is unique to ESOPs. It's a strategy that comes with some complexity, but the potential tax savings can be significant. Let's look at some of the requirements to qualify for this tax deferral, also known as the 1042 tax deferral, which refers to the specific Internal Revenue Code that codified it. The requirements the shareholder of the company must meet to qualify for the 1042 tax deferral are listed here. Some are fairly straightforward, while others we'll discuss in more detail. Let's review each. The first is that the company must be a C corporation at the time of the sale to an ESOP. The company does not have to be a C corporation today. Oftentimes, a company is not a C corporation when they make the decision to sell some or all of its stock to an ESOP, but typically can easily become one through a reorganization. Another requirement is that the ESOP must own 30% of the stock in the company after the sale to the ESOP. The selling shareholder must have held the stock for a minimum of 3 years prior to the sale to the ESOP. The selling shareholder must reinvest the proceeds from the sale into qualified replacement property. This is something we'll talk about in much more detail later. And finally, the seller must make that reinvestment in a 15-month reinvestment window. Now, technically, it's a 15-month reinvestment window. Practically, it's more like a 12-month reinvestment window because the 15-month covers 3 months prior to the sale to the ESOP and 12 months after the sale to the ESOP. The overwhelming majority of clients who take advantage of this tax deferral do so on a post-transaction basis. So at this point, it seems like the tax deferral strategy would be an automatic decision for a business owner selling to an ESOP. There are advantages to being or staying an S corporation. An ESOP trust, who's the legal shareholder in an ESOP construct, is required to own stock in a company. It cannot own membership units in an LLC or an ownership interest in any other type of entity structure. This requires that the underlying company be taxed as either an S Corp or a C Corp. As mentioned on the previous slide, to qualify for 1042, the company must be a C Corp at the time of the sale. However, being a C Corp comes with other negative attributes that should be examined prior to making a decision about which tax election the company will make going forward. Let's look at a side-by-side comparison of C Corps and S Corps to decide which tax structure will be used or how companies decide which tax structure to use. So as we mentioned, as a C Corp, the seller can defer capital gains taxes, whereas an S Corp, seller pays capital gains taxes on their sale to an ESOP. As a C Corp, there's a corporate level tax on income, meaning that any taxable income that the corporation has, it will pay taxes on the entire amount, regardless of who the shareholders are. In an S Corp, its taxable income is not paid at the corporate level, but rather flows through to the shareholders. So the important issue for taxation in S-Corps is, how are the shareholders taxed? The C-Corp does have the ability to reduce the corporate level tax with any dividends it pays to the ESOP. This is a great way to reduce taxable income in a C-Corp ESOP. However, there is no tax on an ESOP share of earnings in an S-Corp. The ultimate example of this is if an ESOP trust owns 100% of the S-Corp, that company is not subject to any federal income tax, and neither is the ESOP shareholder. This effectively creates a tax-exempt organization. Both C-Corps and S-Corps can reduce debt on a pre-tax basis in the ESOP. This is because interest and principal can be paid pre-tax in the C-Corp and S-Corp scenarios under the ESOP construct. So while the selling shareholder clearly has an advantage in the C-Corp situation, the company clearly has an advantage in the S-Corp scenario where it can become a tax-exempt entity. So the decision often comes down to the comparison of how much capital gains the shareholder can defer in the C-Corp situation to how much additional free cash flow the company has in the S-Corp scenario. So let's look at how much a shareholder can really save in the capital gains taxes through this 1042 tax deferral. The difference can be considerable depending on what the seller's tax basis is and the stock that they're selling. Let's look at this example. For every $10 million that are sold in a transaction with third-party sale, the proceeds are likely to be taxed at a blend of capital gains and ordinary income tax rates. This can be a significant tax bill on $10 million, up to $2.9 million in this example, which yields about $7.1 million in after-tax proceeds. In the sale to an ESOP in which you remain an S-Corp, the seller will only be subject to capital gains taxes. This can raise the net proceeds from $7.1 to $7.6 million. In the C-Corp scenario, where the seller can defer all their capital gains taxes, they can realize all $10 million of their proceeds on an after-tax basis. So we reviewed the requirements required to qualify for this 1042 treatment. The one that requires the most analysis and the most explanation is the reinvestment into qualified replacement property. So let's look at that in more detail. So what is qualified replacement property? Essentially, it is securities issued by a domestic taxable operating company. This can include common or preferred stock in those companies. It can also include bonds that are issued by those companies, and often includes floating rate notes. Floating rate notes are not a common investment outside of the ESOP community. In fact, floating rate notes are created specifically for ESOP transactions to facilitate the 1042 capital gain deferral, so much so that they're often referred to as ESOP bonds. Now, why are floating rate notes so attractive for an ESOP transaction? Primarily because they are the perfect collateral for a margin loan issued by your investment advisor. And what that means is that you can invest in the floating rate notes, defer the capital gain for a long period of time, and still get to use most of your proceeds from your sale. Typically up to 90% of those proceeds are usable by you, with 10% remaining invested in the floating rate notes and deferring 100% of the capital gains for a very long period of time. How long of a period of time is a good question. Typically, ESOP bonds last 40 to 50 years and defer the capital gain for that period of time. So what's a safe investment for a 40 to 50 year period? What company's floating rate notes or debt would you want to own for that long of a period of time? Some historical floating rate note issuers are listed here on the slide. Given their names and historic success, investors feel comfortable investing in debt of this long duration. Typically, they have credit ratings somewhere between A and AAA, and because they're specifically designed for these ESOP transactions, and the owner of these floating rate notes is saving a tremendous amount of tax by deferring their capital gains, they do not pay very much interest. In fact, they often pay at a discount to LIBOR. And with LIBOR yielding very low rates, this results in a very low interest rate associated with these bonds. Floating rate notes are not intended to be long-term investments on their own, and their best use is the deferral of capital gains taxes in ESOP transactions. In a transaction example, for every $10 million gain deferral, you need to purchase $10 million of floating rate notes. To do so, you will need $1 million of cash, which will be held as a long-term asset by you, the floating rate note owner. You will then have $9 million of cash available from your $10 million sale, which you can spend. You can invest in a diversified portfolio. You can use for other purposes as opposed to deferring the capital gain. So even though you need to leave $1 million invested in the QRP, the after-tax cash available is still greater than that of a taxable sale. Also, the $1 million invested in the floating rate notes is still valuable to you and your heirs, much like any other long-term investment. So how do we preserve this tax deferral and never pay the capital gains tax on the sale to an ESOP? What we really want to do is move this from a tax deferral to an elimination. Previously, we mentioned these bonds last for 40 to 50 years. They are intended to outlive you as the owner. This will move the qualified replacement property from a personal asset into your estate. Once it's moved into your estate upon your passing, the basis in that floating rate note gets stepped up to the date of death value. This means it will pass on to your heirs, and the capital gain from the sale of your business will be eliminated altogether. There are other active strategies that can be executed in a shorter time frame. Often, qualified replacement property is disposed of if you incur any investment losses. You can offset those losses by selling some of your QRP and realizing the gain. Generally, there are very sophisticated estate planning tools to move your QRP out of your taxable estate prior to your death. We always recommend you consult with your estate planning advisors to investigate those. In summary, a sale to an ESOP is taxed at capital gains rates with the opportunity to defer or eliminate that tax altogether. The ability to defer your capital gains taxes in the sale to an ESOP can provide significant tax savings for you, the seller. The key aspect is to examine is if the C-Corp election is going to inhibit corporate cash flows going forward compared to the pass-through nature of the S-Corp. It needs to be carefully modeled and stressed. The decision often comes down to how much gain the seller has in their stock versus how much they can defer in taxes compared to how much taxable income the company can shield going forward. The good news is the sale to an ESOP is extremely flexible and can allow the seller and the company to determine the ideal scenario for their specific situation. The flexibility of an ESOP allows shareholders to customize their transaction to meet their needs and those of the company and its employees. If the capital gain deferral available under the ESOP structure makes sense for the business owner, then it is achievable and can provide significantly more after-tax dollars to the seller as compared to other types of liquidity strategies. If you are considering an ESOP or would like to discuss ESOPs in further detail, please reach out to us at your convenience. We also welcome your comments and questions about this presentation specifically. So please feel free to contact me at my information listed here. Thank you for joining me today. Please check out our PCE's website at pcecompanies.com for all of our information on ESOPs and other liquidity strategies. And if you like this presentation, please subscribe to our YouTube channel so that you'll be notified whenever new content is posted.